Hello everybody, today I'm going to speak about Microsoft stock analysis. So the ticker is MSFT, and this presentation is following the last financial results on March 2020. Current share price at the moment is $154, and all the metrics will be based on this value. The way I do the presentation for a stock company now is very clear. It's split into five different steps. And based on the financial results, we have three main elements, which are the income statement, the balance sheet, and also the cash flow statements. So we will go through these three items, and based on this, we will extract the data and then create an identity card for the company, which will give us more visibility to see if investment is worth or not. Also at the end, I will make a quick comparison with the company Alphabet, just to give you an idea of the different metrics and to have a decent comparison with another big company like Google. So let's jump directly into the income statements. But before, I just want to make a quick overview of the business. So basically, Microsoft is investing or has different sales subdivisions, which are software. So all these are Microsoft Windows, all the PCs and devices, so they sell hardware. They are also involved into entertainment, so into the PC games and also via the Xbox. They look also into the business software and also developer. When you look into the different thank yous, so the financial reports, the quarterly and the annual, they split their revenue into three subdivisions. So the first one is the productivity and business process. The second one is intelligent cloud, and the last one is a personal computing. As you can see, from 2018 to 2019, all of them have been increasing, but the cloud is the main driver for the growth, which has increased year over year of 26%. Okay, now let's jump directly into the income statement. So I like to present this via different graphs. And just to have an idea of how, over the last 4 quarters, to see how the margins and OPEX splits have been evolving. So as you can see on the first graph, the blue items are the gross margins, and they've been very stable at 67% over the last 4 quarters. You can see also that the net income has been fluctuating between 29 and 30, let's say 9%, which is a very healthy net income margin. On the second graph, you can see that the revenue has been increasing almost sequentially quarter over quarter, except for on Q3 that was a little bit lower. But overall, this is a very healthy trend for the last quarters. If you compare year over year, the revenue increase was 14%, 1/4, so which is quite decent for such a big company. Regarding the OPEX split, so as you can see, the cost of products remains, let's say, around 30%. The SG&A is always stable between 16 and 19%. As I mentioned already, the net income is between 29 and 39%. But what is very interesting here is to see how much the company is investing into research and development. And more than 10% for a company is really, really, really good. So here it's quite stable between 12 and 14%. And to give you an idea of how much they invest per year, it's around $16 billion, 16 billion. And actually this company is the third, biggest company, the third biggest research and development investment in the whole, stock market, after Amazon and Google. Now let's jump into the balance sheet. So here I made just one single graph, and split all the items of the balance sheet. And basically, what you can see here, I split basically, I took the values from the last 4 quarters. So for each item, you will see like Q1, Q2, Q3, and Q4. so that you have an idea of how the, let's say, the liquidity, the cash, or the debt can be evolving over the last 4 quarters. It can give us an indication of if the company is getting bad or if it is getting better. So as you can see here on the balance sheet, nothing has really moved over the last 4 quarters. What I'm really looking into first is the long-term liabilities, which has been stable over the last 4 quarters. And also I look into the liquidities, so which is like the short-term assets. All the pink elements are the short-term assets. As you can see, they have very important amount of short-term investment, but they can directly, if any loss of cash, they can reinvest, put it back to cash and equivalent. Just to give you an idea and summarize this and compare values with values, it's not because they have they look to have a big long-term liability that is a bad balance sheet. You need to put that in comparison with the short-term assets, which is corresponding to 59% of the whole book value. And as you can see, the total of short-term debt and long-term debt is around 60%, which is almost equal to the short-term assets. So basically, the company doesn't have any issue of cash, and even if they have a problem, let's say in the next quarters, they can easily reimburse their short-term debt and even long-term debt if required. Over the last 4 quarters, what is interesting to see is that the equity value has increased, and this is a very good sign. Now let's jump to the cash flow statement. So I put 2 different graphs here. The quarterly graph, so as you can see, it stopped in July, the 2019 fiscal year stopped in July 2019 and started already. So we are actually here at Q2 2020. But what is interesting to see here is the yearly cash flow statement. And I split every year the operating cash flow in green, investing cash flow in orange, and the financing cash flow in red. So this is to give you an idea of the balancing of the cash flow and how it is used. So as you can see, over the last 4 years, the operating cash flow has been very strong, over $30 billion per year, which allowed them to be able to reinvest this cash, also to pay some dividend, to buy back some shares, and even to pay up the debt. So as you can see here on the financing part, the red part, over the last 2 years, it was really big, let's say, investment into the financing, which is basically the fact that they pay around $10 billion into dividend, $10 billion into buyback, shares buyback, but also they reimburse their long-term debt at the moment. That's the reason why you have on these last 2 years a very, very important amount of financing ratio. On the investment, nothing to highlight. They usually have a capex every year of $10 billion. So much less than what they produce in operating cash flow. So to me, it is a very, very healthy cash flow statement. Now let's jump into quickly into the shares outstanding, just to give you an idea of how much they buy back share. But over the last 4 years, it's equivalent to only 2%, even though they put around $10 billion buyback every year. Okay, so based on these 3 elements, we can create the ID card. So just take everything, like the main data from the income statement, from the balance sheet, and from the cash flow statement. We end up with this identity card. So the main objective here is first to identify what would be the yield return of free cash flow. So it means how much at this value, market share value, would the company give you as a return. So I just detail the free cash flow for me is like the earning minus the depreciation of the year, and I divide it by the enterprise value. It is a bit more accurate than dividing by the market cap because you consider the working capital, the long-term debt, and also the long-term investment. Overall, at the price of $154, the yield return is only or at least 2.8%. I do the same calculation just based on the last quarter and multiply by 4 to get a yearly return of 2.9%. Also, the other metric that I like to have is if, let's say, the company is not investing in research and development anymore, how much the company will yield. And you reach a good return of 4.5%. So overall, this is quite good. It's not let's say stunning like 10% plus, but it's still a good return overall. Then after, what we can look is into these like value metrics. So just to have an idea of what is the enterprise value divided by sales. So like is like a better accurate, more accurate value than the price to sales. But basically it's like around 9. The EV to sales around 9 with, so it's a little bit high, but based on the fact that they have a very good net margin of 30+%, this is the reason why the company is a bit highly valued in terms of EV to sales. Ideally, I like to compare the gross margin, 67%, with like a EV to sales similar, so it would be like a EV to sales around 6 would be let's say a better value. But overall, it's quite good. They also have a decent price to cash, so it means that anything like less than 10 on price to cash is decent. So as I was mentioning, in the cash flow statement, they were paying a dividend of like a minimum dividend. Is not a blue chip that yields like more than 5%, but it's because they invest a lot into research and development. So that's why for such technology growth company, you cannot expect to have a big dividend. But I prefer the company to invest into research and development rather than in dividends. Also, what I'm very interested into is to look at the ratio of long-term debt divided by the yearly earning. And it gives us an idea of how many years they would have to work to reimburse the long-term debt. If the ratio is less than 4, as per Warren Buffett, let's say, recommendation, the company is in a healthy state. So a ratio of 2.6 for me is a decent value, and I'm not very worried about the company being bankrupt. The next item that I like to look at is the efficiency of the company. So you can look at the operating revenue per employee, and it can give you an idea, like a feeling of how the company is performing. And per employee, every employee every year just generates $631,000. And this value is really, really good. In an average, as you can, if you look at other companies, they just have between $100,000 and $200,000 per year per employee. So it's really good. Also, what is important to look at during this crisis, if they start having issues in terms of revenue, how much cash the company has per employee. So this is, for me, an interesting, let's say, metric during this crisis, just to see if a company will go bankrupt or has to fire employees. But basically, Microsoft is way over the average with more than $900,000 per employee. So it's good. They would not have to fire any employee for the next, let's say, year or two, even though the crisis might be longer. The last point I like to look at is the revenue growth. So you can see I compare always the revenue growth with the OPEX growth. What is important to look at is if the company is growing revenue, how much OPEX it is growing. So without the two, you cannot really have an idea of how we're going to go, in which direction we will be going. And that's why also I just compare the revenue growth for the last 3 years and the OPEX growth for the last 3 years. So as you can see here, there's a very, very healthy values, which is that the revenue grows even more than the OPEX. So they will leverage more money, they will leverage more, and more money will go on the bottom line, which means more operating cash flow, more free cash flow. So overall, when I look at this, even though the ratios of the yield return are less than 5%, I believe that this company has a very, very strong metrics. Now, as I was mentioning, I was giving just a quick comparison, so I call that a battle between Microsoft and Google. So what I look at, my different criteria to compare a company with another one is the free cash flow divided by the EV, if you don't incorporate the research and development, I compare also the revenue growth for the last 3 years. I compare the net margin. I compare the leverage, so it's between basically the difference between the revenue growth and the OPEX growth. I look into the operating revenue per employee just to evaluate the efficiency of the company. I also look at the long-term debt divided by earning, the retained earning divided by the market cap, and also the cash per employee. When I compare this face-to-face Microsoft against Google, Google even gets better than Microsoft, and basically I get a 6 versus 2. 6 for Google versus 2 for Microsoft. So based on this comparison, I would say that Google is even better than Microsoft. Okay, so just to give my final points as a conclusion on where this company is going, is basically the company is very, very strong in terms of balance sheet. As you could see on the ID card. They have also a very strong point, which is for me the investment into research and development, which I was mentioning was equivalent of $16 billion. So this is basically guaranteeing you that you will have revenue growth over the next years because any research and development will transfer into revenues. Also, they have a very impressive cash amount available and a good ratio of cash available per employee. The future growth prospects are quite large, and even during the crisis, I think they still have a lot of tailwinds in their subdivisions. So, for example, in the clouds, in Microsoft Teams for communication, in Xbox games for all these gaming that will be increasing over the crisis. And also they developed this new technology related to augmented reality. So I think about the HoloLens 2 that might be a bigger source of revenue over the next years. And overall, what is important to look at is if they have any issue in the next, let's say, year or two, which I don't think they will have, they can always cut their spending on the buyback and the dividend, which amount around $20 billion. So it means that they have a lot of room in terms of if they have any issue in the, let's say, in this year, coming year, that they can just reduce a little bit this spending and they can keep at least the research and development investment as it is. So overall, let me know what you think about in the comments. And if you have any comments or any suggestions for the next videos that you would see to be analyzed, just let me know in the comment and then I will try to help. All right, thank you very much guys, and then see you next time.